Happy New Year. RJ Baxter here with Intercap Lending with your 2023 interest rate and housing forecast. I'm going to go deep on where I think housing's going, where I think interest rates are going. So I hope you find this information valuable. I do think it's going to be a strong year for housing, and I do think interest rates are going to come down. And I'm going to go into the reasons why to help you to understand why I believe that interest rates and housing are going there. Now, I want to remind you of one program before we get into this. In light of interest rates going down in 2023, Intercap has a program called FreeFi, where if you buy a home with Intercap Lending before the end of March 2023, we will refinance your mortgage for absolutely no lender fees within the next 2 years. So that way you can lock in a house now at the low prices that we're seeing, or not low prices, but at lower competition than we've been seeing. So you can get a good deal on a house, and then you can get the payment down later with no lender fees. So call me if you have questions about that program, or if you want to discuss what I'm talking about here on this presentation or your personal situation. Happy to go into that with you. Now let's get into the data. All right, so let's get into the interest rate and housing forecast for 2023. And this is courtesy of Barry Habib and the great folks at MBS Highway. And in case you don't know who Barry is, Barry Habib he's one of the best economic forecasters in the industry, not just for housing, but for the economy as a whole. He's actually won an award called the Crystal Ball Award quite a few years over the past decade. And this award goes to the economist that does the best job of forecasting what's going to happen with the economy. So very reliable source, and I agree with exactly what he's saying here, and that's why I wanted to present this today. So let's get into some of the data and the charts and look at what is going to happen ahead. I think it's going to be a strong year for housing. I think interest rates are going to go down, generally speaking. Let's talk about why. So the first thing to understand is that inflation drives mortgage rates. Inflation has a loose correlation with where interest rates are. And if you think about that, the reason why is that the inflation erodes the value of that fixed payment that the owner of the mortgage is receiving. So if they're receiving a certain payment and inflation goes up, then that payment is worth less because that's eroding the value of that. So you can see that this loose correlation exists here, with the red line being the core consumer price index, which is a measure of inflation, and the blue line being the 30-year fixed mortgage rate. Now, we had an era over the past 2 years after COVID, or during COVID, where the Federal Reserve was doing what's called quantitative easing. They were buying mortgage-backed securities in an effort to keep mortgage rates artificially low. And they've done this historically. This is the third or fourth time they've done quantitative easing. But during this period, it was interesting to see that inflation started showing signs of going up in the middle of 2021, as you can see by the red line here. This is when the Fed was using the language that inflation was transitory. They were under the impression that inflation was only going to temporarily spike and was going to come back down on its own without any intervention. And that absolutely did not happen. And we saw inflation continue to go up. Now, during this initial time of inflation, the Fed was artificially keeping rates down through quantitative easing by buying mortgage-backed securities. They were increasing the demand for the securities that back mortgages, which allowed them to keep rates around that 3% rate that we all enjoyed for so long. But in January, actually December, they reversed course and they stopped the quantitative easing period and allowed interest rates to start going up in relation to inflation. And we've seen exactly that happen. You can see here by this chart how rates have increased over the course of the last year, as we all know. So when will inflation peak? I think it's already peaked. And I'm going to share a couple of reasons why. The first is how inflation is calculated. So inflation, the core consumer price index, now core means they strip out food and energy costs. It's all the other basket of goods and services that's in that calculation. And this is a 12-month look back on the average, on the monthly readings. So they add up all the monthly readings over the past 12 months and they get the year-over-year number, which currently sits at 6%. Now that's lower than it was just a couple months ago. And part of that, or the reason why, is how they calculate it. So if you look at the October number of 2022 coming in at 0.3%, that replaced October of 2021, which was 0.6%. So the net effect was the core consumer price index went down by 0.3%. The same thing happened in November, 0.2% versus 0.5%. And then if you look forward, the numbers are also high, 0.6 in December, 0.6 in January, 0.5 in February. So these numbers likely will be replaced by lower numbers, and I'm going to show you why. And if that trend does continue, we could continue to see inflation go down at the beginning of this year, which is what I think we're going to see happen. You see these numbers are almost all high through June, excluding March. So this is a good thing for how consumer price index is calculated. Now, one of the big things that comes into consumer price index is shelter cost. Shelter cost is 39% of the number for the core consumer price index. And if you look at apartment list rent, year-over-year change, you can see that that number is coming down significantly. However, this is a lagging indicator. So shelter costs are lagging for a couple of reasons. First of all, because of that year-over-year calculation, it's a 12-month look back. And also, if you think about someone that's signing a lease for an apartment, that's a 12-month agreement at a minimum usually. And as those contracts are starting to expire here at these higher rates from January, we're going to start to see this number continue to mediate and go down and level out. So that's a key factor, is as these 12-month leases that were at those higher rates expire, they're either going to go up at a lesser pace, or they're going to mediate or level out. So as this shelter component of core CPI continues to come down, we're likely to see overall CPI come down. And if you look at this blue line, this is the year-over-year average or year-over-year change. And you can see how this is still trending up, but we're going to start to shave off these numbers that were really, really high back in January, February, March of last year. It's kind of like a roller coaster where January is the peak here, where we're just coming over the peak of the highest cost that were a year ago. Real shelter costs are here, and shelter and CPI is a 12-month look back, so it's a lagging indicator. It's like you're the back row in the roller coaster. And as these current shelter costs pull that number down, we're going to start to see shelter costs accelerate in their decline. So whether they actually decline or not, I don't know, but certainly that number is going to be lower as far as the increases. So also, the other thing to keep in mind or to know is that all segments are lower except for shelter right now. Prices have come down across the board: food, gas, clothing, and they're all reflected in the CPI. But shelter costs, 39% of core CPI, although decelerating, are still showing increases in CPI due to the lag effect. And we see the same thing in food, gas, and clothing, that it's a lagging indicator. So if the number 12 months ago was still high, we have to replace that with a lower number now for CPI to come down. Now, another thing to keep in mind that's very important is the correlation between 30-year mortgage rates and the 10-year Treasury spread. Now, it's not a direct correlation. It's not day-to-day where as soon as the 10-year changes a certain percentage, the 30-year changes the exact same percentage, but it's a loose correlation. If you look all the way back 35 years ago, you can see how these two interest rates loosely follow each other. And what we've seen over time is the normal spread is between 175 basis points to 200 basis points, or to say it another way, 1.75% to 2% is a normal spread between the 30-year fixed mortgage rate and the 10-year Treasury spread. Now, what has happened recently? Recently, the spread was 300 basis points. Why did that happen? The reason why is the markets were thinking that as rates went up to 7% or thereabouts, that it was more likely that people were going to refinance in the short term. Part of the value of a mortgage is what we call servicing premium, or servicing fees that the servicers receive for actually servicing the mortgage, for collecting the payment, answering phone calls from consumers, distributing the escrows, things like that. There's a certain value in that servicing premium, and they look at that value over the course of a longer term. Now, they usually measure that in the course of years, but what they were doing recently, and they still are, is they're measuring it more like in months. So the market is expecting, as we head in, as inflation comes down, as we potentially head into recession, that people are going to be able to refinance out of that 7% rate. And that's therefore the servicer is not going to get that long-term benefit of servicing that mortgage. So instead of pricing in at a 2% higher spread, they were pricing in at a 3% higher spread. Now, we have seen interest rates start to subside a little bit, and that has been accelerated by the fact that as we get closer to 6%, rates currently low sixes, the providers of the mortgages are starting to value the servicing a little bit more. We've seen this spread narrowing a little bit to more like 2.5, 2.6% as the 30-year goes into more like the 3.5% range. So this is good news, and it's likely that this is going to accelerate to get to a point where we get to more like that historic 2% spread. And we expect the 10-year Treasury to get more like down by 3% or maybe a little bit lower. And if we go back to this historic spread, that suggests that if we're at a 3% 10-year Treasury, that we're going to be at more like a 5% 30-year mortgage rate. And that is more valuable to the servicer than a 6% rate, because 5% is less likely to refinance sooner, and even more valuable than a 7%. And that's part of why we think that this spread is going to narrow to more like historic norms. Next thing is if we're not already in a recession, it's definitely coming. And there are two huge indicators that suggest this. The first is credit card and other revolving debt. People are maintaining the lifestyle that they've enjoyed, but they're doing it through credit. You can see credit card and revolving debt skyrocketing over the past year. And also savings rate, let me move my camera. Savings rate has been plummeting. So people are maintaining their lifestyle through running up their credit cards and through draining their savings, which is a bad sign. There is a limit to how long this can go on, to where there's a breaking point and things start to crash. Another indicator is what we call the inverted yield curve. What we're looking at here is the 10-year Treasury versus the 3-month Treasury. Now, if you think about this logically, typically if you put your money away for a 10-year fixed payment, if you tie it up for 10 years, you should get a higher rate of return than if you tie it up for 3 months, and that's historically what it's been. Well, what an inverted yield curve is, it means that you're actually getting more return on your money for investing for 3 months as opposed to investing it for 10 years, which is a huge predictor of recession, almost a perfect indicator of recession. And if you look back all the way to the early 80s, this line is the 10-year minus the 3-month, which normally would be a positive number. 10-year higher minus a lower number is a positive number. But inverted means we're getting a negative number. And if you look here, negative number, inverted yield curve, recession. Negative number, recession. Negative number, recession. Negative number, recession. And we're currently extremely negative. And this is another huge thing to watch, and is a historically reliable predictor of recession. And in recession, interest rates go down. So this is another thing to keep in mind. The next thing to look at is housing demand. Household formations, which are when a new household is formed, like when the kids move out of the house and get a house of their own, or another example might be, let's say, a divorce and there's 2 households formed from one. But the most common is kids growing up and forming their own household and buying a home. And you can see this number is way down this year. Currently 1.3 million. It's historically more like 1.7 million per year. And part of the reason why this is down is because people are hesitant. Interest rates are up. Housing prices are up, and people are hesitant and generally speaking are holding back. So if you look at new housing supply, this is the other key to this. Housing starts completed, 1.5 million is, that's the number that we're looking at right now. There's 100,000 homes that need to be replaced annually because they just age and they're no longer habitable. So that means the total new supply net of housing is 1.4 million, which is enough to satisfy the household formations number of 1.3 million. But once interest rates come down and housing picks up and people become more confident and those households begin being formed at historic norms of 1.7 million, you can see here there's going to be a huge deficit of new supply coming on the market for housing. And the other thing to know is that builders are very cautious right now. They learned their lessons from 06 to 09, and we're seeing builder confidence down. We're seeing housing starts down. This is the completed number, keep in mind. The housing starts number is down. So this is another thing, if housing starts continue to go down or stay down, then we're going to see a huge glut in supply when existing home supply is also low. So as household formations go back up and we see an increase in demand due to lower interest rates, this could become a huge problem again, like we've seen in the past couple of years with supply being way too low. All right. So home price moderation. So we're hardly seeing a crash. The media is making it out like housing's starting to crash or it's going to crash. But if you look at the actual numbers, housing prices nationwide are down on average 2.5%. This is hardly a crash. This is not doomsday. It's not a scenario like 2008 at this point. We've seen a modest price correction, but this is not a crash. And if you look at what's happened over the last 10 years, housing up 115% over the last 10 years and 39% over the last 2 years, we've only given back a little bit of those gains. So we're not seeing a crash happening right now. And the next thing to look at is affordability. So affordability is an interesting number to look at, and it's another one that the media tends to make out to be worse than it is. So if you look at, first of all, an average home last year, a year ago, was around 400,000. This is nationwide median. Interest rate 3.5% gives a monthly payment of $1,796 principal and interest. With a 10% appreciation rate, that means that same house is 440,000, and at a 6.25 rate, the monthly payment would now be $2,709, an increase of $913. Now that's a big increase and something that most households cannot absorb. But this is only part of the equation. This is only one side of it, and this is where the media tends to get it wrong. If you look at also household income in relation to the monthly payment on housing, household incomes are up an average of 9% nationwide. So if you take the average household income, so this could be two incomes or a household with a single income, on average nationwide is $9,000 per month. A 9% increase means the average is now $98.10 per month, which is an increase of $810 per month. Now that doesn't quite overcome that $913 increase, but it's a good portion of it. And this is part of why we're seeing people pull back a little bit. Even though incomes are up, that monthly payment is so much higher that they're cautious right now. And if you take into account the fact that gas, food, and services are up as well, the total amount on average that those expenses are up is $1,154. So there's a huge gap between household income and how much expenses have increased, but not as bad as the media has made it out to be because of that increase in household income. Now, if we fast forward into next year, 2023, or this year, if we only get a 5% increase in household incomes, now that's $1,300 more than it was 2 years ago. So we're at $10,300 per month, and that would offset that increase in housing cost and gas, food, and services. And let's say that interest rates moderate to 5% like we're expecting. That means the monthly payment on that same $440,000 home comes down to $2,362. And now you can see that people are going to be feeling more confident. That increase in incomes far exceeds the increase in monthly expenses. And this is where we could see things start to heat up again as buyers jump back into the market. So here's the housing forecast. Lower inflation ahead for the reasons that we discussed. Recession-like slowdown. We're looking at almost certainly a recession if we're not in one already. Incomes increasing to help affordability, like we just talked about. Very, very tight inventory environment still, just like we've seen the past couple of years. And rents are still expensive and rising. Now, not rising as much as they were, but still rising. So this doesn't give people too many alternatives. They either have to buy and lock in that payment, or they have to absorb ever-increasing rents. So what we expect is low single-digit appreciation for most of the U.S., and with a pickup of activity going into spring and summer, highly likely, in my opinion, that this could transpire this way. Mortgage rate forecast. We have, first of all, the headwinds. Global quantitative tightening, meaning the opposite of quantitative easing like we talked about before, where federal governments are pulling back on supporting lower interest rates. They're raising rates. They are buying less securities, so they're allowing interest rates to go up. Lack of foreign central bank buying, like I just talked about, and more debt to be financed by the consumer. This is definitely not a good thing. And also for the governments, by the way, the governments have more debt to be financed as they add more to their balance sheets. Tailwinds, lower inflation. As we talked about how inflation is loosely correlated with mortgage rates, and mortgage rates tend to go down in a lower inflation environment. Excess retail inventory, meaning more stuff on the shelves for sale. If you look at supply and demand economics, that brings prices down. Increase in mortgage servicing values, so that accelerated decrease in mortgage rates relative to the 10-year Treasury note that we talked about. And recession likely, rates decline during recessions. So in summary, 30-year fixed mortgage rates moving towards 5% during the first half of 2023. This is going to be great news for our home buyers. And the U.S. 10-year near 3% or lower. So that's what I got for you. Whoop. Accidentally fast forwarded. Let's go back, previous. So let me know if you have questions, if you'd like to talk about this, discuss. I'm definitely here for you on that. And once again, my name is RJ Baxter with Intercap Lending. Have a great rest of your day, and I wish you prosperity and happiness in 2023. Happy New Year.